Will Canada's housing market see a 30% drop in 2021? Well, one major Canadian bank seems to think so. What's up, everybody? Welcome back to the channel. I'm your host, Danish, and I make personal finance, investing, and real estate topics easy to understand and keep up with. The Canadian housing market continues to defy all logic. When I see numbers skyrocketing month after month and reaching all-time highs, this is absolutely insane. We're in the middle of a historic pandemic. Unemployment is historically high, and I've lost count the number of businesses that have gone under. The employees lucky enough to be working, many have either lost bonuses for the year or have been told not to expect any raises anytime soon. Meaning, come January 1, you'll be taking home even less money with the rise in CPP rates, plus add on inflation to the cost of living. You're going to be falling even further behind already as soon as the calendar year changes. Even with all that, the Canadian housing market is thriving, not wilting away. A senior economist from the Bank of Montreal has called out 2020 to be a banner of a year for the Canadian real estate market. Despite condo sales falling, Toronto home sales are up 24% year over year for the month of November. Demand for single-family homes is surging, despite the fact that some of them are close to $1 million or even beyond that. Talk about putting all your eggs in one basket. Low-rise suburban homes have become increasingly popular ever since the outbreak of COVID-19. Prices for Brandon, Manitoba are up 20% year over year. Chilliwack, BC, 22% year over year. South Shore, Nova Scotia, 36% year over year increase. Gatineau, Quebec, 24% year over year increase. Windsor, Ontario, 25% year over year increase. Where is the logic here? Maybe we need something bigger than a global health pandemic to shock the Canadian real estate market. There's an old saying that comes to mind when I think about all this. The higher they rise, the harder they fall. The ones who are buying homes right now are the ones that have already seen their equity skyrocket from a prior purchase. This is why there is at least pressure in the condo markets. Those who have seen their condos go from $200K to $600K are now looking to sell in order to buy single-family homes in smaller markets. Problem is, now they're pricing out those who actually live in those smaller markets. People from large towns and smaller cities are moving to rural areas. And apart from those who are living in the city, looking for more spacious homes in the suburbs, the lack of supply is also causing sky-high prices. This is the reality we find ourselves in today. Later in the video, we'll find out which one of Canada's largest banks is calling for that 30% price drop next year. The Bank of Canada has now officially stated that they can actually drop the current benchmark interest rate from 0.25% to a much lower setting. Meaning the benchmark interest rate could potentially be 0. That's right, 0. To me, considering the current state of the housing market, this will only create more problems than potentially solve. Everyone is so used to low interest rates. In fact, a lot of people are banking on the fact that interest rates stay low for the long haul. Even small increases in the cost of borrowing could push many households to defaults. You lower the cost of borrowing, and this will only increase the pool of buyers in the market, which will lead to more bidding wars, as housing supply isn't going up anytime soon. Many European countries have already shifted to negative interest rates as part of their desperate struggle to kickstart a struggling economy and boost inflation. The Deputy Governor of the Bank of Canada has already stated that he doesn't believe in negative interest rates can be productive for Canada. But that could very well change should the Bank of Canada decide that negative interest rates are now necessary for the Canadian market. As of right now, the Bank of Canada will continue their quantitative easing approach by buying $4 billion of government debt per week. The concern of Canadian economics is very real. And before we look at the forecast from one of the largest banks in Canada, one Bay Street research firm is expecting Canadian real estate prices to drop up to 26% next year. Veritas Investment Research, a prominent Canadian firm, recently sent out their clients a Canadian real estate forecast. Although they mentioned price declines in Canadian real estate are unlikely, except in the event of a supply shock. They now believe that a supply shock will come much sooner rather than later and can send prices up to 26% lower. The yellow flag in their report: a higher portion of real estate investors are looking to sell their investment properties. What does this mean for the big picture? With more real estate investors planning to sell their properties, that supply needs to be absorbed by new buyers. However, real estate investors looking to buy right now are expecting favorable purchase pricing. A price gap between potential sellers and buyers could lead to a correction in real estate categories with a higher concentration in investment properties. Now, where could we see a future supply shock come from? Here's where things get interesting. There are two main sources of potential supply coming to the market in the near horizon. The first is from properties tied to mortgage deferrals that are expecting financial hardship. And the second, from real estate investors who are looking to sell because of a softening rental market. This is where we come to RBC. Canada's largest bank is forecasting a price drop that most would not even be able to digest. The Royal Bank of Canada has prepared potential scenarios on where this Canadian real estate market is headed. Typically, when firms and companies prepare forecasts, they assess several risk factors, along with different economic scenarios that can lead to various outcomes. Standard practice is to take your various scenarios and put them into 3 different buckets. Best case scenario: this is where everything you expect lines up in the most ideal way possible. Worst case scenario: this is everything you expect to go wrong does go wrong. The third bucket being called the base scenario. This is essentially your middle of the road or the average of your worst case and your best case scenario. When I worked in corporate accounting, I had to prepare many iterations of these forecasts and scenarios to give our investors an understanding of where we think the company is headed. Think about when you're looking to buy a stock for any given company. Wouldn't you want a roadmap to see where they're headed and what kind of risks are associated with their business to give you a better understanding of should you be investing in this company or not? The one thing to note is that these are not random numbers. They are reasonable outcomes that can be expected. RBC has done the exact same thing with what they expect to happen with the Canadian real estate market. Over the next year, their base forecast virtually shows flat growth. In their best case scenario, growth would be modest compared to trends we've seen in prior years, but not off by that much. Specifically, in their best case scenario, the bank is calling for a 6% rise over the next 12 months. In their worst case scenario, this is where things start to get interesting. They're forecasting prices to have the biggest drop not seen since the 1980s. Similar to what Moody's is calling for, RBC is forecasting a price drop of just under 30% in the national average selling price. This would be the absolute worst case scenario. The last time Canada saw such a major price drop was back in the 1980s. So to all the naysayers, price drops do happen and can happen. But again, this is the worst case scenario. A lot would have to go wrong for this to happen. For example, a substantial increase in mortgage defaults, combined with a rapid increase in housing supply, as I mentioned earlier in the video. In a more likely scenario, RBC's chief risk officer is instead calling for prices to drop next year by 7% and is expecting prices to stay depressed until 2023. As it stands right now, the problem of trying to save for a down payment, the fact is that cost of living, housing in particular, is rising faster than people's ability to save for it. If you don't have family wealth to help you save for a down payment, it is an absolute nightmare when the amount you need to save keeps going up, as do your expenses and everything else, except your wages. That's it for this video. Thank you so much for watching. Make sure you've already hit that like and subscribe button. Leave your comments down below on where do you think the housing prices are headed. And I'll catch you guys in the next one.